Hi, and welcome to the Fund Selectors podcast with me, your host, Lucy Walker. This podcast has been a long time in the making. I hope you'll all know that I am a huge supporter of the voice of the fund buyer, and this podcast was really born out of that. It's intended to delve deep into the minds behind our biggest and best fund selectors. I'm delighted that our first guest today is Simon Evan Cook, somebody who realistically needs little introduction, but I'll give him one just in case. Simon has a long career in fund research and fund management, but he recently took the plunge of setting up a fund of fund franchise at Downing, where today he is a fund manager, and they run the Downing Fox fund range. Simon is well known not just for his fantastic experience, but for his vocal advocacy of particularly active fund management and the ability for fund managers to outperform over the long term if they have an edge. Those are some of the topics that we're going to delve into today. But for those of you who want to hear more from Simon, because I'm sure you will, he is a regular speaker on many platforms. Medium is where he has a blog. He writes regularly for Citywire, and he has his own investment letters for Downing Fox. I really hope you enjoy this episode as much as I did, and look forward to seeing you next time. Hi, Simon. Delighted to have you here.
Glad to be here. Thank you for having me.
My pleasure. My first guest on the Fund Selectors podcast, and I know it's going to be a fun one because we've had endless chats prior to this happening. But yeah, really excited to get you into a scenario where I can just pummel you with questions and you get to waffle on to your heart's content.
Yeah, absolutely. I'm looking forward to being pummeled, and I'm honoured to be your first guest. I'm going down in history as your first guest. That's great.
Absolutely. Yeah, great. Cool. Well, let's dive straight in. So what I really wanted to start with is, you I think have probably in the industry one of the best known philosophies, but I suspect there will be some people that don't know, and there will be others that maybe know kind of snippets but don't know the kind of end to end. So give us a flavour for what your philosophy is when you're building your fund of fund portfolios.
Sure. There's a lot of ways at coming at this. The philosophy is pretty steady. It doesn't change much, but there are 100 different ways of describing different aspects of it. But ultimately, I guess what it is that I'm a huge believer in active fund managers. So when you look at one of my portfolios, you will see that as the dominant theme. So especially in the equity world, I believe that it is possible for a talented, experienced, diligent individual to beat the market by focusing on something that they're particularly good at. And I think that if you find a selection of those, you too can beat the market. And that is ultimately what it is. So my entire business and the portfolios are built around that. So I've been lucky enough to start up at Downing Fox, and I've built the funds that I run there around that philosophy. It is the ability for me to find those people and their ability then to add value over the market by what are effectively, I guess, old school, tried and trusted techniques of finding companies and beating the market.
Love that. And yeah, so exciting that you've started up at Downing. And what was it like being able to start with a completely blank sheet of paper?
It was exciting. It was, hopefully what I've described is fairly simple there, but when you really start to drill down into what's involved in putting a portfolio together, there are a lot of moving parts. So I really enjoyed it. There was a bit of what I used to do. So there were some older funds in there, fund managers I'd known from the past. But it was also great for me to go out there and meet some new fund managers and bring them in as well, because the way that we've structured things at Downing is that fund of funds, so that's what I'm running, fund of funds rather than an open portfolio, have been challenged for the last 10 years or so, basically because the charges were too high. So we had to find a way of bringing the charges down. Now, part of that was simply us not charging as much. That's pretty simple stuff. But the other part was to find a way of bringing down the charges of the fund managers we own. Now, we're not going to be able to go to a fund manager who's well established, who's got a load of money already running, and demand or ask nicely. We don't demand ever, but ask nicely for a discount, because why would they do that for us? So it's quite a good challenge, because we're going to see new fund managers, and they're not necessarily new in the sense that they're young or it's their first job. We don't have anyone who's running money who is their first job, but new in the sense that maybe they've left a bigger company where they didn't like the red tape, or they were being dragged away from what they love doing, and they've now started up at a boutique or at a slightly smaller firm somewhere. We've got to a point in the industry where people are not prepared to take a risk and back those types of funds, and because of that, those of us who are getting much better deals. So it's a new part of what we do, is having that very strict discipline on the charges we pay, because otherwise people won't buy the funds, because the charges are considered to be too high, even if you could argue that they're not. If you find a fund manager who's giving you 5% a year above the index and you pay them 1%, then I'd say that's still very good value. But the point is, we've got to a point in the industry where the optics of charges have become more important than the actual reality of charges. So we pander to that, but it was just great getting out there again, meeting a load of new fund managers, particularly meeting the kind of fund managers I love as well, who are generally very passionate about what they do and are real people, and they're not corporate stooges. So it was a lot of fun.
Yeah, I bet. Brings back some good memories. What would you say? Because that completely resonates with you talking about the kind of the ones that were really passionate are the ones that where you get the most out of it. What do you think? What is it about those fund managers that kind of eludes that or exudes that kind of passion? And what do you look for in a fund manager that gives you that kind of indicator?
Well, there's a load of stuff, right? But I wrote an article on this, and it's on. So I post a lot of financial writing on medium.com, and the piece I've written that is by a factor of about 10 the most popular thing I've ever written was basically about this question of what separates a great fund manager from an average one. There's plenty of average ones around, but obviously we're not interested in backing them, because once you back an average manager, once you pay them the fees, there's really not enough left for the client at the end of it. So we really are looking for exceptional fund managers. What I mentioned in that, I had to make up a word for a trait, because there isn't a word that, to my mind, really adequately describes what it is we're looking for. And the word I made up was belicious, which is a mixture of belligerent and conscientious. What I'm trying to describe there is, I've heard other people describe it as disagreeability in the past, which is the ability to sort of be stubbornly different to everyone else. But I don't like the term disagreeable, because it has negative connotation. It implies someone is a bit of an arsehole, if you'll pardon my French, but it implies someone who is not, who is maybe going against people for the sake of going against people sometimes. Well, that's not it. What we need is someone who is prepared to be different, because they really wholeheartedly believe in what they do. Now, that might mean sometimes they're actually looking just as everyone else does, because what they happen to believe looks the same as what everyone else happens to be believing at that point. But other times it will look incredibly different to what everyone else is doing. And at that point, we need someone who's got that stubborn ability to be very different to everyone else. So those two words, belligerent and conscientious, mixed together, to me, sum up that trait. Now, I think it's a vanishing trait in the world at large, but particularly in the fund management world, because if you think about what our world does currently, and it's a constant bugbear of mine, is that it selects for a certain type of person, and that the way it selects is that you get exams even at primary school. Now, you've got children, I've got children, they've been put through all these exams, and you've got them going through then exams at GCSE, then exams at A-level, and then exams at university. And really, to pass those exams, you don't need to have a rebel mind, as it were. You really need to have the kind of mind that can do what it's told to some degree or another. Because I mean, I think of my youngest son, who is a little bit of a rebel in the way he thinks. If he's studying something and he can't see the point in doing it, he won't study it. He just thinks, this is wasting my time. Now, it's a pain in the neck for me as a parent. It's like that, because you keep trying to say, you just need to jump through these hoops. And then when you get through the hoops, then you can be different and you can go on a different path. But that's exactly what it's like with fund managers. They've got to get through these hoops, and they slowly, gradually select for people who are good at doing what they're told, and they siphon out the rebels to some extent. So when you get to a point when you finally got this desirable job, and it is a desirable job being a fund manager, you find that a lot of the rebels have been siphoned out. But the point when you become a fund manager is the point when actually you really need to have that slightly rebellious spirit, that ability to say, I've got this chance now to run this portfolio, and you know what? I think the market is mad the way it's positioned, and I'm going to do something different, because when I think of the principles I believe in and I think of the way you should run money, the way my portfolio looks is very, very different to how the market looks, and I'm going my way, not the way I'm told to go. And I think those people are quite rare, but some do make it through happily, and they're the ones pretty much I like, which is why when you look through my portfolio, you'll see a lot of boutiques in there. You'll see a lot of fund managers who maybe got sick of working at a large company and being told what to do, and having a risk management team who questioned every decision. Not that that's necessarily a bad thing, but sometimes it creeps too far. Obviously you think of Neil Woodford as an example of that, where some risk management wouldn't have got amiss. But it's finding that type of fund manager who's got that rebellious spirit, but is structured enough not to go rogue, if that makes sense.
It makes complete sense. And yeah, I remember reading about Belicious. I think I always used to call it kind of a combination of arrogance and humility, and kind of the balance, or the tipping point of that is it's so important, because you do need both, and ultimately they are kind of counterbalancing, and so it's such a fascinating perspective to look at it from the angle of kind of belligerence and conscientiousness. But I think they have a really similar kind of
they do, yeah. That's
sort of
such a good way
underlying
of
philosophy.
describing that. I like that arrogance, humility. I've looked in the past some of the paradoxes. I think you need to be a great fund manager, and that's definitely one of them. And another one is being flexibly dogmatic as well, where you need to really run your process and stick with it and stick with it and stick with it until such time as actually you spot the little flaw in your process, or the bit where it's about to drive you into a brick wall. And maybe at that point you circumnavigate the process a little bit to avoid that one flaw in it. That's a really hard thing to pull off, because you're either one thing or the other. So to be able to kind of switch that on and off is again really rare. But there are tons of paradoxes like that of being a great fund manager, I think.
And how if we take that one, flexibly dogmatic, that as you say, I would agree that's potentially one of the hardest ones, both probably to look for, but also to encompass, just because it's such a tricky thing. How do you go about looking for that?
Well, you have to look through their history, I guess. You have to look at situations. So I enjoy the fund manager meeting. For me, that is a fun hour. It's quite an exhausting hour. We used to do days where we do 3 or 4 in a day, and at the end of it, my brain was just like jelly, because I'm on for it. I'm a curious person anyway. I don't tend to have a fixed agenda when I'm going in and speaking to a fund manager. I'll kick them off normally by asking for the origin story, for one of a better way of putting it, so we get a sense of the sort of person they are, and then I'll just take that where it goes. And I'm really looking to find flaws. I'm kind of poking fingers into little cracks as they appear and exploring it. And as a fund selector, I think to a certain extent, and not wanting to give away any tricks at all, but you have to be a little bit of a tricky pony, because fund managers are smart people, right? And they'll sometimes anticipate your question. It's interesting how many times you'll be in a meeting with a fund manager, and then they will assume that you're asking or implying something with a question, when actually you're asking a perfectly open question. Now, sometimes that just happens naturally anyway. I'm asking an open question, and then they'll give quite a defensive response. I see what you're implying there. And you think, well, I wasn't implying anything. I was literally just asking the question. But sometimes you can ask a slightly leading question in the intention that it'll be leading them left, when actually I think the right answer is right. And it takes a certain type of person, to come back to your original question, to actually say, actually, no, I disagree with your statement like question, because actually I think right. the best way to go. I don't agree that we should do it this way. I think actually we should do it the other way. That's quite hard to do to someone who's potentially going to put money into your fund, and I think that's quite a good marker of that beliciousness, if you like, that ability to kind of be prepared potentially to disappoint me in a meeting, upset me. I mean, they're not going to upset me, but in terms of just say something they think that I won't like to hear. I think that's a very strong marker of someone who is on their own path. I've always thought of a fund manager meeting. I've tried to describe it this way in the past. Imagine if you are sat in front of someone, but there's a kind of curtain between you, and you've got an object that you've got to describe in front of you, but there's someone next to you also separated by a curtain, who doesn't have that object in front of them to describe. Now, you could ask those two people, one with the object, one without, questions, and you'd be able to catch out the one without the object, I think, because you'd be able to ask them something that they wouldn't be able to guess about it. And that's effectively what I'm trying to do when I'm questioning. If I feel like someone is able to, whichever angle I come at in that fund manager meeting, describe a process that is coherent and fits with what it should be, then it sounds to me like they know their process. If you can come at the other person who doesn't know their process very well from an angle where they've said one thing before and they say something that then contradicts it, or they haven't maybe thought about it from that angle, and you therefore find that they've got a weakness because they haven't really considered what might happen if X, then that's the kind of fund manager you maybe want to avoid. So yeah, that whole process of tapping the thing until you find the hollow sound, yeah, that to me is a big part of it.
Yeah, completely. Again, it's all bringing back all the memories from my Fund Selector days. Particularly the one where you ask a genuinely open question, and actually you get, there's obviously some nervousness there, right, about something, and it's triggered that kind of defensive reaction, and it's quite enlightening, isn't it, actually,
Oh,
when that
absolutely,
happens.
yeah.
So yeah, it's a good reminder to fund managers that actually just come in and kind of own your truth, and if you are a fit, then great, and if you're not a fit, that's also okay. You'll be a fit for somebody else. I think you mentioned about there being a lot of average fund managers out there, and I would definitely agree with that, but I suspect you would also agree there are a lot of really great fund managers out there as well. And what I always say to people is, actually, there are so many good fund managers out there. It's not about I've got the best fund, or I'm better than this peer. It's actually about, this is what I am, and if you want to be a part of it, amazing, and if you don't, that's also cool. Does that kind of resonate with you?
It does, yeah. And it's a point of philosophy, isn't it? Because I'm sure there are a lot of fund managers who've worked hard as an analyst, worked hard, got their CFA, did all that kind of thing, are finally put in charge of a fund, and then frozen like a rabbit in the headlights, and then ended up buying whatever the equivalent of the Magnificent Seven was at the time, despite being a value manager. But imagine how that must feel, right, to get your opportunity and then to basically fluff it, to freeze in the floodlights, as it were, because you weren't prepared to do what you actually believe. You kind of, at some point, you're probably going to be removed from the job at that point, and that sense of regret would be massive. That, actually, this is what I believed. I believed I should have been investing in mid-sized value companies, but I basically puked and ended up buying a load of large caps because that's what was doing well, because I was worried about my career. And you end up losing that career because you don't focus on becoming the thing that you should be. Now, that doesn't mean being the thing that you should be is risk-free, because if you happen to be someone who's a believer in mid-cap value at a time when mid-cap value doesn't do well for 3 or 4 years, you're equally going to end your career, but at least you went out fighting. And that's, to me, that's the way I think of things. I would hate to have sat on the fence and then seen the fence fall over. You should absolutely follow your beliefs and do what you believe is the right way to do it. And that way, if it goes wrong, then at least you've still got your principles and your morals intact. Whereas if you don't do what you believe and it goes wrong, then you're going to be living with that regret forever.
So true, so true. I think you also hit on a really important point for the industry, which is career risk. You talked about, obviously, somebody buying perhaps Magnificent Seven when they should be buying mid-cap value. How do you think asset managers should deal? Obviously, your approach to dealing with that risk is to go with predominantly boutiques where career risk is typically lower. Actually, the bigger risk is kind of raising assets to be a business that actually survives. But for an asset manager, I think it's really important in this kind of new world that we're in now, with all the consolidation and, with active, passive, etc., that actually you're seeing asset managers give their fund managers a genuine chance. And obviously we know that cycles can last a lot longer than, people can underperform for a lot longer than perhaps they did in the past, or than previously people have been prepared to tolerate. What would your kind of message be to the asset management industry to raise this kind of big issue of career risk?
I think the best analogy, and it's one that I've borrowed from Angus Tulloch, who is, as you know, was but your listeners might not, was a kind of legend of the industry, an excellent investor, but also a good person with it. But he used the analogy of the garden. And I think that is such a rich way of looking at things, because whether you're running a portfolio or whether you're running a company in which you hire portfolio managers, you need to make sure that you've got diversity there. And importantly, what you need to make sure that you're not doing is having one year when it's a certain type of weather and therefore a certain type of plant doesn't grow. Let's say it's a particularly dry year. In the UK, they're rare. And I remember someone telling me in the past about how in the UK 20 years ago, there was a situation where we had, I think, 2 hot summers in a row, and suddenly every golf course in the country spent hundreds of thousands of pounds putting sprinklers in, which they never used ever again because it just rained solidly for years. But it's the same problem in that if you get 2 years where your value manager is not performing, to wrench that out and replace it with a growth fund manager, sod's law, you're going to get the conditions change again, and it's going to start raining at the point when you've just put in a plant that likes dry weather. So you just have to treat it like a flower bed, if you like, except that not everything you plant is going to be working at all times. And actually, if you want a strong business and a strong portfolio, it's a lot better to make sure that everything isn't working at the same time, because you should probably be quite suspicious if it is, because if conditions then change in a way that you might be able to foresee or in a way that you might not be able to foresee, then potentially everything you have is only suitable for one set of conditions. And you see that so often in the fund management industry. Certain houses become associated with a certain type of style, which has ruled the roost for 7, 8, 9 years, and they begin to wheedle out all the stuff that isn't that thing. And, after 8, 9, 10 years of that style or that process or whatever it might be, being the thing that works, everything is that way. And then when the world changes, which it invariably does, all of that stuff collapses, and suddenly your entire business is screwed because you don't have any diversifiers there. So absolutely, you should be looking at your crop of fund managers as a selection of plants. You just make sure that they're diverse. Make sure, and if you've got a gap somewhere and you think, okay, we've got a gap in Japanese value, for example, but no one's buying Japanese value currently, that probably means that actually in the Darwinian world of fund management, that in 6, 7 years time, everyone will be scrambling to buy Japanese value, and they won't be buying the thing that you're scrambling to launch at the point. They'll be buying the thing that's been up and running for 4 or 5 years and has got the track record and has got the chops to prove that it is a genuine Japanese value fund. Again, so it's just about being a little bit forward thinking, not about predicting the future, but just accepting that it can change. And obviously all that, as you mentioned, just absolutely fits in with the way that we run the portfolios as well. We make sure that we have the same thing happening. We should be suspicious if we've got 30 funds and all 30 are working. We should be more worried about that than happy, I think.
Yeah, completely. So true, and such good advice for asset managers across the industry. With regards to your portfolios, do you want to give us a bit of a flavour for, you've talked a bit about this sort of philosophy at the beginning, and we've heard from, you about boutiques and the rest, but do you want to give us an idea of kind of what do the portfolios look like if you were in with a client and kind of giving them an idea, what would it look like? What would your portfolios kind of stand for?
Yeah, maybe it's a good point to talk about the problem I'm trying to solve at Downing Fox. And that problem is that, as you mentioned, I think there are actually plenty of great fund managers out there. I think it's what you'd call in tech world a picnic problem. Picnic stands for problem in chair, not in computer. And it's that people don't know how to use active funds very well. The funds themselves are great. You think of an example like a Baillie Gifford. I think Baillie Gifford are very good fund managers. They're one of the best at the part of the ecosystem they work in, which is high growth investing. But because they only focus on doing one type of investing, it's very hard for people to hold their funds, I believe, because most people haven't had the training that their fund managers have, or the experience being brought up in investing, and then experiencing it, and then having 20 years of seeing the ebb and flow of markets, which you possibly need to become a good investor to see just how it can go wrong. If you're a vet or you're a teacher, you're an accountant, and you've got other stuff to worry about, you're not trained for that experience of seeing a fund be way, way better than the market for 3 years, and then see it being way, way worse than the market for a year. And sod's law, it's not even sod's law, it's just the nature of things that you buy it after it's been good, and then you see it be bad for a year or two, and then you sell it after it's been bad, and then maybe when you're selling it, you're buying the fund that's done well for the previous 3 years while you've been doing badly. Rinse and repeat, and after a while everyone loses the will to live, and they hate active fund managers because they see the whole thing as being a giant con. They're not. They're just hard to use. So I see the purpose of Downing Fox is to find these amazing fund managers, but put them together into such a way that normal people can still use the funds. And again, that comes on to what we were just talking about before. So it's find amazing growth fund managers, find amazing quality fund managers, find amazing value fund managers, and stick with them for 10 years, and know that you're going to have dry years in there, you're going to have wet years in there, and while one is doing really well, another will be doing very badly. But they'll compensate for each other. But at the end of 10 years, provided I've done my job and found great fund managers, you'll get the average of all of their returns, and you'll get the average of all of their journeys. So you'll get that smoother journey, which becomes a lot easier to use than if you're just backing one of these amazing fund managers. So I see that's the role that Downing Fox has in the ecosystem. And that's a really good place in terms of understanding the portfolios we run at Downing Fox, what they are and what they do. If you just look at our 100% equity portfolio, that's what it is. It's stuffed full of the most active fund managers that we can find, all running the same principles we've just discussed for the last 20 minutes or so, in terms of they're proper fund managers. They're not kind of guarding against career risk, because they are taking decisions that look very, very different to the market. And holding any one of those might be quite difficult emotional experience, but holding 30 of them becomes actually a much easier experience. And at the end of it, you still hopefully get that great return that's above the market. So it's about the user experience. And as someone talking to someone who's obviously well aware of that, given your move into the tech world, I think it's something that the fund management world is probably a wee bit behind on. I quite often compare it to maybe where the tech industry was at the end of the 90s, or maybe even the early noughties, where there were incredible processors out there, but because the industry was run by predominantly male tech geeks, they weren't put together in a way that the average person could actually really use those. So where Windows came along and was really powerful, and after that, the iPhone, was it took all this amazing processing power and packaged it in such a way that actually people could start to use it. So that's the mission at Downing Fox, if you like. So we have the 100% equity portfolio, which is all active fund managers. But then we also have an 80% version and a 60% version and a 40%. And you'll have heard me refer to this in the past as the whiskey and water model. We call it that for a number of reasons, but one of them is that I'm perfectly happy to drink the 100% proof model neat, because I've got 20 years till I retire. I've got a relatively good tolerance for risk. I understand what that journey is going to look like, but not everyone has that same tolerance. So we, if you like, almost have to offer a dilution service. So that's what we do. You can buy the Downing Fox whiskey, if you like, but you can get it in an 80% version, a 60% version, and a 40% version. And so our job there is, with the bit that isn't in equity, is just to make sure that that genuinely dilutes So again, in terms of helping the user experience, making sure that someone who is a bit more nervous about equities actually gets an experience that is less nerve-wracking than holding 100% equities. Now, most of the time, that's pretty easy. But in 2022, it wasn't. And you saw a lot of bond portfolio, which is the classic diluter, if you like, of equities tank. And we didn't hold any bonds. So it was a good place for us to kind of kick off. When you look at our portfolios, they did relatively well last year because they didn't get carried down. Bonds actually, in many cases, did worse than equities.
Yeah.
So we've just got to make sure that we do that dilution job for our clients as well. So that, I think, pretty much sums it up. Active equities on one part, and then making sure we dilute it down for your average user. So they basically, we just want to keep them on the journey, right? I'm a great believer that it's time in the markets, not timing the markets. And the more we can do to help investors stay invested by making the journey bearable, ultimately, the better their retirement's going to be, or the bigger the pot they can pay for university fees or whatever it is that they happen to be saving for.
Absolutely love that. Yeah, the iPhone of the investment industry, and see
Wouldn't
how
that
much
be lovely?
see how much water you need with your whiskey. That's that's great. I want to dig into a little bit into that point you made about time in the market rather than timing the market, because I think that it's interesting. You're blending a lot of styles, whether it's quality, value, growth. You've got different caps. I wonder if you can just touch on how you think about that in terms of, because I know the answer from our previous conversations, but I think it would be really helpful for those listening to hear about how you think about splitting those different styles, blending those, and how that may or may not change over time.
Yeah, I mean, it starts from a position of, so the big argument, or one of the big arguments in asset management, is between value investors and growth investors. A bit like cats and dogs. They don't agree, they don't see eye to eye. And in that sense, it's a bit like politics, that actually progressives and conservatives don't agree, they're at each other's throats. But once you take a sort of step back from it and look at the whole thing as a system, you see that actually one of them isn't right and one of them isn't wrong. There are certain times when it's right to be value, and certain times when it's right to be progressive, and there are certain times when it's right to be conservative, and there are certain times it's right to be growth. So actually, when you kind of remove yourself from your own personal feelings about an investment style or even a political style and look at the whole thing, you kind of think, you know what, actually you need those to make the whole thing work. Once you've got that perspective, I believe that value management, if it's done well, can make you a lot of money. I believe that growth fund management, if it's done well, can make you a lot of money. You become a little bit more pragmatic about life and think, actually, so we just need to find the best of both. So we do that, we find that, and then my experience in the past of running money at the company I was at before was at a company called Premier Miton, and the funds did very well there, but we did well almost in spite of our biases. So for the 10 years from about 2010 to 2020, we had biases that were basically quite unhelpful. I mean, we had a value bias when it was a decade that growth did well. We had geographical biases, which put us against the US. Our value bias put us against the US, and the US was pretty much the only game in town. But happily, all of our kind of other principles about finding active fund managers and finding talented individuals way more than compensated for that. So my learning there was, maybe just don't do that. Just find the best of each discipline, be they small cap, mid cap, large cap, and just stick with them. Don't try and time it. Don't try and be, right, this year we're going to be value and next year we're going to be growth, because I've never seen anyone do that well, and you end up destroying a lot more value than you create. It's about long-term investing. So it's find the amazing fund manager, stick with them for 10 years. But as I mentioned before, just make sure that you've got different fund managers doing different things in there, but importantly, they're doing things that work. So again, back to the question of finding fund managers, we focus wholeheartedly on processes that we believe can work. And there's a lot of things that do and a lot of things that don't. But I guess one of the most important aspects for us is we pick bottom-up stock pickers. We're quite ruthless about not taking thematic top-down investors. And what I mean by that is investors who say, right, I think inflation is coming back, so I'm going to make my entire portfolio inflation-friendly stocks, because I don't think it's possible to get that call right in a timely manner. You can be right, but you can be 4 or 5 years too early, and that's as good as being wrong. So we do look for bottom-up stock pickers. Now, they might build inflationary considerations or deflation considerations into their stock considerations, but what they're not doing is flipping the portfolio around based on something a macroeconomist told them.
You said something that I wanted to dig into a bit, which is, process, and some work and some don't. There are lots of different ways of obviously running money and different processes, and typically, you always see a slide with a lovely kind of filter down pot, and then maybe some buckets. What are your thoughts on all of that kind of stuff, and what asset managers can do differently, or what perhaps fund selectors should look out for when it comes to thinking about process?
It's a great question, and when I look at a lot of those slides in a deck, you tend to see a process that describes almost what I was doing 2 years ago, which is as if you were creating a process or a portfolio from scratch from the start. So the process looks like you're doing it every week. You're creating a brand new process or a new portfolio. Obviously, you're not doing that. You do that once, and after that, it's maintenance. So that's the first thing I'd say, is that when you look at those process slides, it almost looks like the wrong way around. What you really want to understand is how they drive the vehicle once it's up and running. So that's the first thing to consider. I think what I do like about understanding a process is you just need to get to the edge as quickly as possible. It's finding out what it is that they do. If they're trying to find the best quality companies, then you really want to understand how they do that. How do they manage that? How do they bring that into the process? Is it the first thing they screen for? Do they screen at all? Or is it actually, are they honest enough to say, actually, we don't even do screens. We've been doing this long enough that we've got a network of people we know and we speak to, and ideas just pop up and come out of the ether. I suspect that happens a hell of a lot more than you would imagine it would if you just looked at process decks. So many process decks kind of say, there's a screen, there's a hopper, these ideas come through. From my experience of my own process, and for the experience of looking at other fund managers' process, I don't think in most cases that ideas come from that screen. They do in some cases, for sure, but in many other cases, it comes from the fact that they were speaking to one company, and this company mentioned a supplier they've got who happens to be very good in their own niche, so they explore that rabbit hole, and you just kind of end up running down various rabbit holes, and you end up finding something that's excellent. And I think a better way of describing that would help a lot of fund managers, because if that's what they do, that's what I want to know. A kind of a line of questioning I'm spending more time thinking about now, and more time questioning about, is the actual decision-making structure of a team, because quite often you'll just get that bland slide of 10 faces, this is the so-and-so analyst, this is the PMs. And I used to spend maybe a kind of 30 seconds on that slide, and it'd be like a whatever, let's get on to the process. But I'm realizing now that is way more important than I was giving it credit for in the past, because you really need to understand who is actually making the decisions here. Is it one person genuinely making those decisions and somebody else just feeding them ideas which they're rejecting? Is that one person who's a decision maker actually really getting involved in finding the ideas, or are they literally just there as a kind of a cipher, if you like, that people put the ideas into, and then they have a talent for finding the best of somebody else's ideas and then putting them in the portfolio? Or are there actually 3 or 4 people, and it's a much flatter structure, and they're all between them coming to some kind of consensus about what it is? I don't think any one of those is better than the other ones. All of them can be great. All of them can be terrible as well if they're done badly. I think you can have team processes that are amazing, and you can have team processes that turn into something like a committee and they're awful. But it really is, for me, just understanding that, because then that helps then when the manager leaves, or you get a problem further down the line, or one of the team leaves, because it's very easy to assume that the manager you're speaking to is the person who's creating the alpha. But actually, was it that somebody else was really creating those ideas and was the creative spark, or was the person who was maybe providing a little bit of strategic thinking that fund manager if left alone, can't manage themselves. So it's so important to understand that dynamic. And I've very rarely seen that set out in a presentation very well.
Super interesting perspective. I think it's a great one for truly understanding and kind of getting under the skin of things. And I find when you ask questions, like you mentioned the origin story at the beginning, and you've touched now on kind of the team dynamics, I think when you start to dig into those things, that's when often you get the real gold to truly understand, not kind of the surface level what's in the deck, but like a true genuine understanding of how that fund operates and how that team operates, which I think makes a real difference.
Yeah, it is, and I've got a co-manager now who's excellent, Alex Paget, who joined me last year. He's very experienced in the fund world anyway, but he's a wee bit younger than I was, and we're coming up to new parts of the process. But we came up with a new rule for fund manager meetings last week. Actually, it's as recent as that, and it was the rule that if you've got a question that pops into your head, no matter how weird that question is, you have to ask it. And I think it was a question that might even been about something personally, that the fund manager was telling us an origin story about how he met someone who he ended up working with, and they ended up sort of dating his sister or whatever it might be. But whatever it is, ask the question, because you never know where it's going to go. In that sense, I take my inspiration from Ricky Gervais, who's got a comedy rule, which is that he and his brother, I think, always used to have a rule where if you thought of something funny, you had to say it out loud, which obviously explains why he's such a deeply inappropriate comic, because he still does that to this day. But we've now got that rule in place in a fund manager meeting. If the question pops in your head, you have to ask it, because I think curiosity is a really powerful force, and that question, even if it seems left field and abstract, might take you down a rabbit hole that will tell you something, either something great about the fund manager, or maybe illuminate something that isn't so great. But I think it's a fantastic way to run a meeting.
I love that. Absolutely love that. I've definitely, over the past, few years of doing my own thing, I've definitely followed my instinct more. And so that really resonates a lot. I wanted to touch on you mentioned there about deep, kind of really, I suppose, deep questioning, and kind of how that can transform things. And I think that the same is true in reverse when asset managers and boutiques are coming to you in terms of what is of interest to you, and the more I think that they have an understanding of their strategy and how it differs, the more I think they can have a richer conversation with the likes of you. And I wondered if you could just touch on that, whether you agree, whether you have any perspectives on what they should and should not be doing.
Well, I think it chimes with something I was saying earlier about take your chance, right? What you don't want to do is turn up to a fund manager or a fund selector meeting with me particularly, and not tell us what you actually do, because a bit like the fund manager in the case I was talking about before, where they don't actually run the fund in a way that accords with the way that they believe things, you should have the same principle with a fund selector meeting, that you should go in there and you should absolutely be focusing on why you are different, and what it is in your process that will make your fund great. Because you think, oh God, maybe what if he doesn't like, what if I'm a small cap value manager and this guy actually doesn't like value? So maybe I should try and pretend a little bit like I've got more of a focus on growth than I actually do. Just don't do that, right? Just if you are a certain type of fund manager, max that. Absolutely hit that as hard as you can, because fund selectors increasingly, and we're definitely like this, and even some of the ones who are maybe a little bit more on the fence are definitely trying to put you into a pigeonhole, and you may as well accept that. But you want to be the best in your pigeonhole effectively. There's no point in knowing that you belong in a certain pigeonhole but pretending that actually you'd be quite good in a different one. Just own your pigeonhole would be the way to do it. So structure your entire presentation around that. Get to it as quickly as possible. Both you and I know Stacey Havner, who's obviously in the States and focuses on origin story, but get as quickly as possible as you can to why you are what you are. I love an origin story whereby you hear why the fund manager runs money the way they do. Maybe it's an experience, maybe it's a mentor they have. When I get that, I understand and I think, okay, great. Because what I'm looking for is a fund manager who's operating in that pigeonhole. Let's say it's small cap value. I want to know that they're going to stay in it. And you're more likely to stay in it if that accords with your personality, if it fits. If you're the sort of person who's a natural contrarian, then tell me the origin story which explains why you're a natural contrarian. So it's about getting that personality to come across. But you can choke. You can go into a meeting and try and be all things to all people and end up being nothing to anyone. And that would be the biggest mistake, I think.
Yeah, could not agree more with that. And you don't need that many supporters, right, to get to a point where you're suddenly more, I suppose, sort of over 100 million. You don't need that many supporters to get to that kind of critical mass.
And we're seeing it as well, because we're at Downing Fox, because we're so adamant about what we do, and we're doing it at a time when actually the industry has become more homogenized and more commoditized. We know that we're not going to appeal to all financial advisors or all clients. But we know that there's a certain type of financial advisor out there, one who's maybe more independently minded and is maybe more focused on results for their clients rather than some kind of different aspect of what they do, maybe more business oriented, or maybe just not wanting to look in any way different from what everyone else is doing. We know who our audience is, and we're landing very, very well with those types of financial advisors because they're not seeing anything else in the market that's like what we do. And it's the same for a fund manager as well. You just have to be the thing that you do, and that way you'll find your tribe of people.
The tribe, that's such a good word for it. You've definitely got lots of deliciousness. Cool. I wanted to talk about fees, because I think that that is a key question in the industry at the moment. You talked about obviously not going to the kind of the big houses, because realistically they can't give you kind of more attractive fee deals. Although I think actually there are some asset managers that are kind of doing more in that space. What I wanted to understand was how you think fees should be structured in an ideal world, or at least what you look for, and then also just kind of the sorts of levels that you're paying, because I think it's quite interesting to really highlight to fund buyers the sorts of attractive fees that they can get by supporting earlier stage vehicles.
Yeah, it's really important, and it's more important currently than perhaps it should be. So in starting our portfolio, we've had to leave a few fund managers behind that I probably wouldn't wanted to necessarily have leave behind, but because they were already established, because they were already up near capacity, we couldn't get them. But the brutal fact of being a fund manager in 2024 is that if your fees aren't attractive, people won't buy them. And it's that simple. It doesn't matter how much you outperform, because increasingly advisors and buyers are just screening out anything that is, let's say, above 1% OCF, so all in charge above 1%. They're just not going to buy it. So unless you hit that level, it almost doesn't matter how good you are, people won't buy it and you won't have a business. So you have to take that into account. I think some flexibility and creativity in terms of charging is a good thing. So obviously the factor we're taking account of is founders' fees. So that is because you have a situation where it is slightly riskier in some ways, particularly maybe career risk, backing an unheard of boutique, even if in other ways it's considerably less risky because the fund manager's better, they've got skin in the game, they're focused, all of those things. But actually, if you're a fund selector, you're thinking, well, I could back a very well-known name, or I could back this company here that's operating out of a kind of office outside of London that no one's heard of. If that one goes wrong, I'm going to look like an idiot. Whereas actually, if the one from the big company goes wrong, then, you never get fired for buying an IBM. It's the same in the fund selection world. So, yeah, you have to offer, I think, a more competitive starting fee to reflect the fact that someone coming in, particularly on day one, as opposed to month one, is taking that risk. And it is a little bit harder. You are going to face more scrutiny if you get something wrong in that world. but I think therefore you should be getting a lower fee for that. And that's what effectively we do. And so the charging structure at Downing Fox is that our equity portfolio, so our 100% equity portfolio, that has to come in a weighted average OCF of 0.5%. So when you add up all the equity fund managers that we purchase, and we think they are all amazing, and they're all highly, highly active, that's what we've achieved at Downing Fox is the ability to do that and to get that to come in at 0.5%. And when you compare to 10, 12 years ago, when actually the average fee for an active fund that people were paying was 1.5%, you can see how fees has become less of an issue in terms of performance over time. So I think that's important. But then they should also then, those fund managers who are offering those founders fees, I think they do limit it. They should limit it to the early adopters. What annoys me sometimes is if I've been an early adopter and then a bigger fund buyer comes along 5 years later when it's an obvious fund to buy, right? So I've picked a fund that has done amazingly, it's shot the lights out, and we've got the founders fee. And that's, if you like, a little bragging right for us, or a little bonus for our clients for backing us, is that they're getting a lower fee. I do find it amazingly annoying if then someone comes along with a big ticket and gets the same fee that I've got. I think your founders fee should be the lowest fee that's available. We have a founders fee at Downing Fox as well. So there is, for substantial early backers for us, that thing. And that, to me, should be the lowest fee that anyone's paying. It will not be a situation where someone comes along with a £200 million ticket in 5 years' time and can get that fee up. It's a point of principle for me that cannot happen. We've got financial advisors who've taken the risk and backed us early. They're going to get the best fee. It doesn't matter how big they are. But so, yeah, I think that needs protecting. What I would like to see is more imagination in terms of looking at structures. Maybe this is where the regulator could help, whereby if you could find a way of seeing whether a fund holder has been with you for 5 years, 10 years, you start to discount for that fund holder. I would love to be able to offer a structure where, for a financial advisor or a financial advisor's client who's been with us for, let's say, 5, 6, 7 years, so they've been with us through the rough and the smooth, whatever we see over the next 5 or 6 years, we can reward them with a more attractive fee because they've been a loyal customer. I think that would be amazing, but it doesn't look like that's possible given the way the world is structured currently. So, yeah, I'd like to see bits and pieces like that come in.
Love that. That would be what a brilliant way to incentivize being long term, which we know is the thing that allows you to be in the market rather than timing the market. And yeah, that is definitely something that we should petition the FCA to consider. I'll do my best to add it to the list. Listen, this has been amazing. I want to finish because we could definitely talk for a whole nother hour, but keeping it to within an hour, I just want to ask you a question. So for those that are interested in Simon's origin story, go and check out Stacey Havener's podcast, which Simon referenced, or Simon referenced her earlier. He talks a lot about his how he got into his position on that podcast, and it's really, really fascinating story. One question I want to ask you though, Simon, because I think it was always my favorite. I loved an origin story as well, and I always one of my favorite questions was a book that had genuinely, not just something you'd enjoyed, but that a book that had genuinely changed the way that you think. And I have a sneaking suspicion I know what it might be, but I don't know because I know you're a big reader. So I'm interested to know whether what it is. Yeah. So what's the book, and why did it change the way that you think about things?
I'm really intrigued to find out what your guess is. I'll ask you that afterwards. I would say, and there are a lot of books, right? I mean, I could pick one of, I'd say 10 to 20 that I think are genuinely influential. Probably the one I would pick, because it's almost like a gateway drug to his world, would be Nassim Taleb's Fooled by Randomness. I didn't actually read that book first, but because it's first in the series, I'm kind of recommending it because I think it's a great way in. And I don't know whether it necessarily changed the way I think, because I think I'm quite naturally inclined to be that way anyway, the way he describes in there. But it definitely made me feel that actually, you know what, I'm not nuts. There are people who think the way that I do. And actually, there's very good reason to think the way that I do, which is slightly different than I was hearing a lot of other people saying at the time, oh, you should do this and you must do that. And I was thinking, well, that doesn't seem right to me. but it seems like I'm crazy if I speak up and say it. But Fooled by Randomness, and then Black Swan and Anti-Fragile and Skin in the Game after that, all amazing books, but they all talk about a very different way of thinking and generally about how most people can be foxed by things that happen every day, by randomness, to go back to the book's title. So that would definitely be the one I would recommend that people read, that chimes with what I do. What I can't tell you is, did it influence me, or did it just allow me to feel more about
Validated.
the way I already felt? Yeah.
Bit of confirmation bias. The book I was thinking of, and actually I should have checked the title in advance, but is the one about systems. The lady, yes. What's her name again? Is it
Donella Meadows? Yeah,
Donella Meadows. Yeah, exactly.
That would definitely be in my top 5, and it would definitely be the one that I would say I can't believe that it isn't taught in schools. So if you ever wanted to study systems thinking, you could probably do it. I think there may be a few universities in the States that do it. Maybe you'd be able to find a course in the UK somewhere that did it, but it should be taught to kids. I mean, it should be taught at primary school, basically after speaking, writing, and adding up. It should be systems thinking, because it is just about how stuff works, how anything works, how our bodies work, how markets work, how forests work, how farming works. And it's basically almost like looking in at the inner plumbing of this stuff. And it allows you to look at how a forest works, for example, and draw parallels and take the experience of understanding how a forest works and apply that to an economy, or understand how an economy works and understand and apply that to a body, or to a school, or to a fund, or a portfolio. It is such powerful, amazing stuff that it absolutely, that book should be taught to kids as early as possible, and yet it's not taught at all. And I tell you absolutely who should be reading it and should be forced to read it and do exams on it, because they love exams, should be anyone who goes into the world of regulation. Because it is so good for understanding unintended consequences, and how if you tweak a system in one way, it can have all these effects which pop up in other areas. And it sets that out in a very nice structure. And I think understanding factors like feedback loops would be so important, and it doesn't seem to be well understood at all by the sort of people who really should understand this type of stuff.
I had to stop myself earlier when you referenced in schools, how kind of exams, and it makes you, kind of weeds out the rebels and kind of makes everybody conform. I had to stop myself sort of making the podcast about how we should revolutionize the school system, and actually you've just kind of further encouraged me. So maybe we'll have to do a part 2, which is what we think should happen in the school system to make it more appropriate.
Yeah, Lucy and Simon rant about education. Yeah, I'm in for it. Yeah.
Amazing. All right. So the last thing then, you're the first guest, so there isn't a question for you, but can you ask what would a question be for the next guest that you'd be interested to hear their thoughts on?
Yeah, I would like to hear the answer to the question, what have you realized that you were completely wrong about? So what do you now think is right that you once thought was wrong? That's probably a more concise way of putting it.
Nice. Love that. Simon, this has been phenomenal. Thank you so much. And have a great rest of your day.
Thank you very much.